$135 billion. That's the staggering profit reported by DatVietVAC, the powerhouse behind Untry Say Hi. This isn't just a number, it's a blueprint for maximizing profit even when revenue dips. A critical lesson for any entrepreneur navigating today's market. DatVietVAC's success can be attributed to their strategic approach to monetization, leveraging the immense popularity of the Untry Say Hi franchise to generate revenue from diverse sources such as merchandise sales, sponsorships, and strategic partnerships. According to a recent report, the franchise's merchandise sales have seen a 300% increase since the launch of the latest season, with sales of over 1 million units in the past quarter alone. DatVietVAC, a major player in media production, just dropped a bombshell with their latest financial report. For the first half of this year, their profit surged to 135 billion VND. What's wild about this? Their revenue actually decreased during the same period. Most businesses panic when sales dip, but DatVietVAC clearly cracked the code on scaling profitability without needing top-line growth. This isn't about luck. It's about a laser focus on efficiency and high-margin operations. We're talking about a strategic pivot that every freelancer, SaaS founder, or Amazon FBA seller needs to understand right now. One key metric that stands out is their cost of goods sold, COGS, which plummeted by 30% year over year. This, combined with a 25% increase in operating expenses, allowed DatVietVAC to maintain a healthy profit margin. Here's the critical insight. When revenue contracts, profit doesn't have to. DatVietVAC's success as the producer of Untry Say Hi points to masterful cost control and margin optimization. We're seeing a clear shift towards operational excellence, cutting unnecessary overhead, streamlining production, or perhaps focusing on higher-value content deals that, while fewer, are significantly more profitable. This isn't just about slashing expenses. It's about smart resource allocation. Think about it. A small team with a highly efficient SaaS product often out-earns a larger company with bloated expenses, even if the latter boasts higher gross revenue. Here's what nobody mentions in the mainstream business news. Sustainable profit often comes from ruthless efficiency and strategic focus, not just chasing endless revenue. DatVietVAC's 135 billion VND profit, even with lower revenue, absolutely proves this. They've effectively shown that a leaner, focused approach can generate serious cash flow. So, what's your next move? Today, I challenge you to audit your own business for revenue killers. Those low-margin products, services or ad spends that silently drain resources. Map out your highest profit areas, then double down on them. Start by analyzing your Shopify Analytics or Amazon FBA reports to identify your top 20% most profitable SKUs. Focus your marketing there. Don't just chase sales, chase profitable sales. Hit subscribe for more direct strategies to build your empire. Top analysts are reevaluating their investment models. Many are now shifting focus from raw revenue growth to pure bottom-line performance for media and entertainment companies. The consensus emerging on Bloomberg and WSJ is clear. The market rewards lean operations more than ever. This trend suggests a mature industry where expense management is the new growth driver. What investors missed for years was the true cost of chasing top-line vanity metrics. Now, the emphasis is squarely on net income, signaling a fundamental recalibration of value across the sector. According to a recent report, the average operating margin for U.S. media companies has increased by 10% in the past year, with notable gains seen in the sectors of video games and streaming services. For instance, Nintendo's operating margin rose from 15.4% to 17%. Across global markets, savvy players are taking note. We're seeing production houses in Europe and Asia quietly adopting similar cost-conscious blueprints, even as their revenue figures remain flat or dip slightly. This isn't just a regional anomaly. It's becoming a global playbook for media giants. Companies like Netflix or Disney, while not directly comparable in scale, are increasingly scrutinized on their content spend efficiency. This global shift opens doors for niche service providers specializing in cross-border financial process refinement for media assets. Think about that competitive edge. According to a recent report by Deloitte, the global media and entertainment sector is projected to experience a 2.5% decrease in content production costs by 2025. largely driven by the adoption of cost-saving strategies. Look back to the dot-com bust of the early 2000s. That era saw a similar, dramatic pivot from growth at all costs to a ruthless focus on cash flow and clear paths to actual earnings. Companies that adapted, cutting fat and finding their core value, survived and thrived. Those that didn't, disappeared. This current environment in media production echoes that historical turning point. The long-term winners were the ones who built resilient business models, not just flashy user numbers. History's telling us to pay attention to the P&L statement, not just the press releases. For instance, companies like eBay and Amazon, who were initially seen as struggling to turn a profit, were able to pivot and focus on their core strengths, leading to significant growth and success. Who truly wins in this profit-first paradigm? The lean, agile content creators and production studios that can deliver high-quality work without bloated budgets. They're grabbing market share. Unexpected beneficiaries include SaaS companies providing sophisticated financial modeling and resource planning tools tailored for media. The losers? Those massive traditional studios burdened with fixed overheads and slow decision-making. Their reliance on outdated structures means they're bleeding cash trying to keep up. This creates a vacuum for innovative, smaller players who understand the new rules of engagement. Take Netflix, for instance, which managed to disrupt the traditional TV model by focusing on original content and using data-driven decision-making to inform their production choices.